Australia's Q1 GDP figures missed the mark, disappointing the RBA and raising the odds of a July rate cut, while markets may cheer the soft data. Longer-term risks for rates and global volatility still in play. Let's head to Adelaide now. We're joined by David Scutt from StoneX. Great to see you. It's been a pretty difficult time to judge what's going to happen next for the economy, but Australia's GDP print, well, came in softer than expected. A technical recession per capita.
Yeah, not quite there at that point when it comes to the technical recession. We still need another negative quarter again. We had a positive quarter back in Q4, but you're right, very soft, 0.2% quarter on quarter, 1.3% on the year, way below our potential growth rate and importantly, way below what the RBA was expecting.
Yes. Do you think that is the case, or do you think the RBA actually secretly did know that this was the case?
I think they're probably hoping that it was going to be a little bit better than expected. But what we're seeing consistently is that if you go and strip out public sector demand, the private sector has been weak and weak for years and years and years. And that really came home to roost yesterday. Now, there's some accounting changes in the actual reports that made it look like public demand was a little bit weaker, electricity subsidies in particular. But the private sector remains very soft at this point in time. There's not a lot of desire to go and invest from businesses, and households remain cautious. And we saw that in particular when it came from the windfall from our disposable income per capita. The positive figure there was funneled into savings rather than really into spending.
Yes, and not surprising. I mean, this wasn't really something that anyone was talking about during the election campaign, was it? About private investment. It's all about government spending at the moment.
It is, and it's been that while for, and we know that NDIS, the expenditure that's going through in that particular area is massive and being really, really positive when it comes to aggregate economic growth. But is it actually delivering the outcomes that we need to go and be a vibrant, dynamic economy moving forward? I'll probably go and suggest no, but that's what's been one of the big growth pillars that we've seen at the moment. You've got to go and have that changeover get solidified to the private sector. And right now, it just doesn't have enough evidence to suggest that that is taking place.
For young players watching this who think that just let the government keep spending, we don't really need money from the private sector, what's the fear there?
Well, to go and pay for it all, you've got to go and get the money from somewhere. And then basically that comes out of your back pocket. And that's where it will go eventually in time. That you can keep funneling all these big expenditure coming through. At some point, it's got to come down to roost, and the Pied Piper will be calling and saying, we need to go and increase taxes on this. We need to go and do this. We can't go and give you this service because we can't afford it. And that's when you start to see our real living standards start to decline. Hopefully we don't get to that point, but we need to go and have a much more balanced outlook when it comes to our expenditure, particularly from the public sector, and how can we go and make our private sector stronger than what they are right now.
Yeah, interesting. You've got the Victorian Treasurer, Jocelyn Simms, in New York, begging the banks there not to, lower Victoria's credit rating despite that nearly $200 billion debt. Let's talk about the July meeting for the RBA. What do you think this will have in store for them? Because there was some belief there could have been a 50 basis point emergency cut the last time around.
Yeah, and I'm glad that you used the word emergency because it's really unusual for the RBA to go and cut big moves like 50 basis points outside of emergency period. So it was interesting in itself that they went and discussed that. Now, after that meeting that we saw the RBA go and cut the cash rate down to 3.85%, we saw markets go and shift to about a 50-50 probability immediately afterwards. You can see there on your screen, we're now priced at over 80% for another 25 basis point cut coming through in July. I'll probably argue that just given the flow of data we've seen, given that we've seen continued weakness coming through in economic growth, particularly in household spending, the RBA is very likely to want to take the cash rate lower again. It needs to get what's called back to the nominal neutral rate. Technical jargon, it's the level that where the cash rate doesn't go and stimulate activity, but it doesn't detract on activity as well. And that's probably somewhere in the low threes at this point in time. So if we get another one coming through in July, I dare say we're probably going to get another one in August as well.
Wow, there you go, making the prediction there. Now, the funny thing about the markets, obviously, is that it quite often does the opposite of what you think it might do. Weak data often fuels market rallies, and the ASX has been doing pretty well.
It has, mate. It's been an absolute tear, and it's been led by the banks, unbelievably, which are already amongst the most valuable banks in the world, based on a whole bunch of different parameters. And you can see here, that's just looking at ASX 200 SPY futures. And they came within a whisker of taking out the record highs last night. 8581 is the level on the top side that we're looking for. everyone can see the chart. Everyone can see the valuations. With all the headlines yesterday about the Commonwealth Bank reaching a $300 billion market cap. The key thing for investors and traders is what happens if and when we get to that record high? How does the price interact with that level? And I think that will be really, really instructive when it comes to sort of medium-term directional risk. The index, I would say, from a fundamental perspective, is very, very expensive now based on historic norms. But from a technical perspective, it looks brilliant. So one of those two is going to end up being the winner. One will be the loser. We'll see what happens when the price gets to the record, if it gets there.
US payroll data, not 110,000 as first expected, 33,000. What does that say about the state of the US economy?
Yeah, the ADP reports, it has a reputation for being a little bit flaky in terms of the signal that it goes, particularly when it comes to the payrolls report released later in the week. But that 37,000 increase was way under expectations, and it followed a downward revision in that data to 60,000 in the prior month. Now, payrolls are printed something like 177,000 in the previous month. It's expected to be a leg lower to 130,000 on this occasion. Just looking at some of the data that's coming through, we're getting mixed reads on the labour market, but that's interesting in itself because for such a long period of time, it was almost unilateral, uniform strength in jobs data in the States. Yeah. And the fact that it's starting to go and waver now suggests that potentially things are starting to go and crack underneath the surface. We get jobless claims out later today in the States, which is going to be interesting, particularly with the Memorial Day holiday as well, that could go and impact things. Yep. Also, payrolls on Friday is going to be a very, very big one for investors and traders.
All right, David Scott, appreciate your time as always. Thank you.
Great to be here.